Hey everyone, this is Kirk here again at optionalpha.com where we show you guys how to make smarter trades. And tonight I want to go over all of the trades that we made for both Tuesday the 23rd and today Wednesday the 24th. And I know I was just late doing these videos, but I've been working tirelessly on our side project that we have getting the new podcast going, which is so cool and so excited about that. So I actually want to give you guys just a very quick sneak peek at kind of the podcast module and page that I've got going here that'll be releasing soon. But I'm basically putting together a bunch of episodes and kind of loading this thing up with about 6 to 8 episodes before I actually launch it. And then after that, we'll actually start going in there and adding a new episode a week. We're going to have scheduled interviews. We've got case studies. We've got people that are going to be on the podcast. It's going to be awesome and just another way to connect with you guys and learn more about options trading. So definitely be on the lookout for that. Hopefully you guys are excited. If you have any topics that you would like covered or interesting things that you want me to talk about on the podcast, please let me know in the comment section. I'd love to get your feedback. But this is definitely going to be a really, really cool thing. And something that not a lot of sites have, even just this ability to kind of flip through and scroll through the different podcasts right from one page. And obviously, it'll be in iTunes and SoundCloud and Stitcher and the whole deal. We'll get it all there ready to go. So that's what I've been working on as far as a little side project. So just a quick sneak peek just for the members here so you guys know what's coming soon. And obviously, it'll be completely free. Okay, so as far as the trades that we made, I want to actually go over the Tesla trade that we closed out of just real quick. And then I want to get to EWZ because we actually had an adjustment to EWZ today and we had an adjustment on Monday that I didn't cover in a video because it was the only adjustment that we had for the day. But I want to kind of wrap those two up today in this video. So the first one is Tesla. Really, there's nothing that we can say about Tesla as far as exiting the trade other than Tesla did exactly what we expected and thought it would do. And it just happened very, very quickly. So I believe we were only in this trade for a little over a week, maybe even 5 days. And Tesla moved lower. We originally had the October 270, 265 debit put spread that we bought in Tesla, very small. But then we're able to sell out of this yesterday at a 390 credit, which took in about $120 on every contract that you did. So with Tesla, there's, again, really nothing to say on this other than the stock did exactly what we thought it was going to do, right? We got into this trade, I believe, right about here when the stock had a nice little rally, but we saw that Tesla had a big move lower and started to show signs with some of the technical analysis that it was going to continue to move lower. And it did exactly that. So over the next couple days, I think 4 or 5 days, Tesla moved from 265 all the way down to around 250. Gave us a great opportunity to close out this trade. What was left in this trade, if we didn't close out of it, even though it had moved down, is only about $1.10 in premium. So that's what was left, is about $1.10 in premium for the rest of October. And given that we'd already made about 125, which is more than 50% of our max potential gain, this is where our rules tell us to get out of the trade and be very systematic with what we're doing. So we went ahead and got out of that trade and have started to move on to the next trades for next month. Okay, so the other trades that we also want to go over, the other trade I want to talk about first is EWZ. So let me go to the chart here of EWZ first so you guys can take a look at where EWZ is. And you'll notice that the stock and ETF has continued to move lower basically for the entire month of September. I mean, so from basically September 3rd all the way till now, it's just continued to trend lower and lower and lower. And our whole strategy this whole time, up until today when we added just one other position, has been to roll down all of our call side trades. So every time that we had a call spread, we would close out a call spread. So we would close out something above it, take in a profit, so bank a profit on that, and we would enter into a new call spread closer to the market. Always matching up the width of strikes and the number of contracts. We were doing them 5, 5, 5 all the way down. And that whole process of making those trade adjustments, what that did is it moved our break-even point further out on the bottom side and then also allowed us to, again, bank those profits on trades that were profitable above the market. So we banked profits, we got closer to the market, kind of readjusted and recentered the strategy. And then on the bottom side, because we took in a new credit, that helped move out our break-even point down below the market. Now, what we did today, and let me just bring up this risk profile here for 1 second so you guys can take a look at that. Now, what we did today is we went back into the market, and let me take off these simulated trades here because I was looking at other trades as well. So we went back into the market today and we added a position below the market. So today's position in EWZ is a completely new position. We're adding to this position. Again, investing more in this trade because implied volatility is high. It's still a very good trade. I like the trade. It's extremely liquid. This is something you can definitely get more aggressive in. And we're still risk defined across the board. So we don't have any undefined risk. We're managing our margin with this trade by staying in all verticals. So today's trade, we went back into October, sold the 44.43 put spread below the market, and added an additional 25 cents in credit. Again, this was a completely new position to the trade, and I just want to show you guys exactly what that looks like. So here's the 44.43 that we added here today. So I just took those off and kind of unhighlighted them from down here in the bottom section. So you'll see that without this trade today, this is where the market's trading, right here about 46.80. And we actually start to lose money in a pretty significant way after 46. So our whole goal here was to move up this maximum loss line here to something a little bit less. So reduce our potential loss should the stock stay here or continue to move a little bit higher. So if we did that and added those trades back in today, you can see what the new position looks like. So now this new position basically has almost no loss, no profit, no gain right until 46. So that line that was down much below the zero barrier has now moved up. So now we have absolutely no loss if the stock stays anywhere above 46. So you can see all the way out well past 54 and 55. There's absolutely no loss if the stock stays above 46. Obviously, we do continue to lose money below 46, but we still lost money below 46, even if we didn't have this adjustment in there. All we've done here is helped additionally protect ourselves in case the stock stays right here and doesn't move. Now, I do think the stock is going to head higher, so we have left a room for us to make some money on this trade between 48 and 51. That's where we have a nice little kind of iron condor shape up here, and that's really kind of the bulk of our position is right here around 48.51 for EWZ. So from today's action, it's definitely rallied today. It's at least stopped moving lower, so I think that it could easily move back into the 48.51 range between now and October expiration. So it could absolutely do something like this where it just continues to move up and settles into that range. So again, I really, really like the trade. This is why we're adding positions to the trade. This is why we're heavily invested in this stock. It's very liquid. It's definitely something that you should consider adding more positions to if you can with your portfolio. Okay, so hopefully that explains the EWZ adjustment. The other adjustment that we made today was in X. And I know that some people had emailed me and said, hey, what ticker symbol is that? And I know it's sometimes confusing with these single ticker symbols, but X, which is US Steel, which is our mega strangle that we carried over from last expiration month, we went ahead and did 2 trades in X. The first trade was closing out our 46 calls. So they were profitable, made a couple $100 on these calls. We bought those back for 55 cents. And then we went back into the market in our second trade. So they were separate trades instead of doing them all at once. And we sold a couple more. So you notice we sold 2 more of the 43 calls above the market. So now the stock was moving lower today, went ahead and sold the 43 calls, took in a credit of 140 on those. And again, I just made some comments that we had rolled down our 46 calls to 43. So again, with US Steel had a big day lower for most of the day, kind of rallied towards the end of the day. Implied volatility is still very, very high in this stock. But if we look at the Analyze tab, we're still positioned very, very well for movement anywhere between about 40.5 and 47. And we can make a pretty good chunk of change here with US Steel as far as expiration goes. So by making that adjustment, basically what we did is just moved in our break-even points on both sides just a little bit. So we kind of shifted the break-evens down just a little bit. But again, these 46 calls over here, not really serving us any purpose. So we went ahead and rolled them closer to the market at 43. So we rolled them closer to the market at 43 here. And that gave us a little bit of extra premium on the roll, helps recenter the trade over the market and banks a profit on those 46 calls. So we did bank a nice little profit on those 46 calls going into it. All right, so let's talk about the opening trades that we had today. So a lot of activity in oil. That's one of those sectors that I actually kind of talked about in the podcast today when I was recording one of the podcasts and one of the segments called The Closing Bell that you guys will hear about later on. But oil is one of those sectors that I think is definitely ready for a little bit of a rebound, and definitely something that I want to at least have a position in should it rebound. I think that it's had a real tough time the last couple of months, and I think that market cyclicality will come back in, and we'll see a little bit of a rebound here in oil. So what we did is we entered a vertical put spread, a vertical credit spread in oil OIH, which is an oil sector ETF, the 49.46, which is a $3 wide spread, took in about 42 cents in credit on the OIH trade. If we go over to OIH, you can see that the stock has had a really, really tough time the last couple of months, but has really had a nice little rebound here towards the end of the day. And even still, implied volatility still remains very, very high in the stock. That allows us then to do those types of strategies that take advantage of high implied volatility, and we can get some premium decay. Now our first strike is at 49, so that's really our line in the sand. We are right here at 49. Ideally, we want OIH to trade anywhere above 49 between now and expiration, and this is really the area that we make some money. So it's a very good trade. I like this trade. Still kept it small, but I like the setup of OIH. Going back, we also did one in XOP, which is oil and gas. So not only just the oil sector, but the oil and gas sector with XOP. And in this case, implied volatility was much higher than some of the other ones across the board. So it was up in that 80th and 70th percentile. And what we did with XOP is we did a short strangle. So we did a 74 naked call and a 67 naked put down below the market. Now, because we did naked on each of these, we didn't have to buy any protection. That allowed us to take in a credit on each individual strangle that we sold of $140. So we took in a credit of about $280 overall. Now, what's interesting about these strangles is that that credit then helps move the break-even points further out beyond our strikes. So in the case of the 74 call, our break-even is actually 74 plus the 140, so we get 75.40. And in the case of the short put, our break-even is actually below 67, so we take 67 minus 140 and we get 65.60 as our break-even points to the bottom and to the top side. If we go to OXP here, then you can see that our break-even on the bottom side is again about 65.60, so all the way down here. And on the top side, it was about 75.40, which is all the way up here. So we've got a pretty massive range and window of opportunity to make some money in this thing if it does continue to move just generally in a sideways fashion. It can still be very volatile heading into October, but this is a very, very big range to take in such a large premium on this trade. Now you'll notice in the top left-hand corner that, again, like I said, IV is up in the 77th percentile. So what that means is that almost 77% of the time over the last year, volatility has been lower than where it is right now. And this gives us an opportunity to sell just pure premium. So it's a little bit more of an advanced trade. It does require higher margin. You could create an iron condor out of this and buy a leg on either side, but I really like this trade by doing it just the strangle. So I actually want to go to XOP here so you guys can see exactly where our positions are on the actual trade tab. So here's our positions in XOP. Down below the market, again, we're at 67. Now 67 has about a 23 0.85% chance of being in the money at expiration. So what this is saying is that there's about a 75% chance, using some rounding, there's about a 75% chance that XOP does not make it down to 67 by expiration. On the top side, we matched it up almost exactly, except for a little bit of movement here today in the market. On the top side with our 74 calls, we matched it up and did a 24% probability of losing if the market does rally. So a 75% chance that it doesn't go up to 74 by expiration. Okay, so that's exactly where we put our strikes. That's how we determined our strikes on this Strangle. I know I get a lot of questions from people saying, okay, Kirk, how do you determine which strikes you want to trade for a Strangle? And in this case, I was comfortable at about the 25% probability level on each leg. I wasn't really tilted one way or the other. I'm not, a little bit more bullish or a little bit more bearish. I'm just making this a very even and wide Strangle on XOP. If you were more conservative than me and you wanted to go to, say, the 15% probability level on each side, then you would move out to the 77.5 calls, and you would move down to somewhere around the 65 puts. Now, you'd obviously take in less premium. You'd take in about 70 cents, 80 cents on that trade. So you take in less money, but you are taking less overall risk because there's a higher chance of success with those trades than with the particular trade that we put on. Still high probability trades, but you're being even more conservative. Okay, so hopefully that helps answer the question about how you determine strike prices with Strangles. And then the last trade that we got into, again, another credit spread today, trying to take advantage of some volatility, is APC. And APC is one that we try to get into for a couple days now, and particularly we tried to get into it last week, we tried to get into it this week, and just finally got something to actually fill in there. And that's the 110-113 call spread above the market. So again, still trying to keep our positions and portfolio fairly balanced. We did the 110-113 call spread for a 50-cent credit. So we sold the 110 calls, bought the 113 calls, took in a 50-cent credit on that. That puts our break even at 110.50 for APC. You'll notice that APC still has high implied volatility right now at 74%. It'll probably stay high for at least another week or so as we, start to get near and closer to earnings. But I'm really looking for this thing to definitely trade below about 110, which is our first strike. So we've got a lot of wiggle room here. The stock can rally all the way up to 110 before we ever start to lose money at expiration. So I'm hoping that if the stock does rally just a little bit, and even if it goes up to like 106 or 107, somewhere in there, that we're going to see a drop in that IV up in the top left-hand corner. We're going to see a drop in that IV, which is actually going to give us a profit, even though the stock is going to move against us. So that's really the whole game plan here. If the stock moves lower, that's great. That's still going to help. But what we're looking for is actually just a slight move higher in the stock, or maybe a sideways move, and a drop in that IV reading of 74 down to around 50 or under 50. That's going to give us a pretty good profit in this thing very quickly, and we'll be out of this trade in about a week or two, ideally. So that's the trade that we made in APC. Now, as always, I hope you guys enjoy these videos. That's all the trades that we made. I know it was a little bit longer. Again, the new podcast is coming out. It should be out in about a week or so. So I'm just finishing up all the fine-tuning touches and getting everything ready to go. So hopefully you guys are excited about that. I'd love to hear your comments, your thoughts, any episodes or topics you want me to cover. Again, just throw them in the comment box right below this video. As always, happy trading.